The average American property tax bill just hit $4,400 a year. In Sunbelt states, homeowners are seeing double-digit jumps in a single year. If you own your home, and you are over 60, four specific pressures are hitting your housing costs right now. Most seniors are missing at least one of them. Here is what they are, and exactly what to do about each one. 1. Your assessed value may be wrong, and you can fight it. Your property tax bill is calculated on one number, your assessed value. When that number goes up, your bill goes up. And right now, in most parts of the country, that number is going up. Home values have climbed roughly 27% above inflation since 2020. County assessors are catching up. That means reassessments are hitting homeowners who have been in their homes for years, sometimes decades, with bills that reflect today's market, not the market when they bought. Here is what most people do not know. You are not required to simply accept that number. Every county is required to give you notice before a new assessed value takes effect. That notice comes with an appeal window. In most states, you have between 30 and 90 days to challenge it. Miss that window, and you are locked into the new value for the full assessment cycle. There is no going back after the deadline, regardless of how high the bill turns out to be. The appeal itself is straightforward. Filing fees run under $50 in most counties. What you need are recent sale prices for comparable homes in your immediate neighborhood. Similar size, similar age, similar condition, sold within the last 12 months. You present those to a review board or hearing officer. If your county's assigned value is higher than what those comparable sales support, you have a legitimate case and a realistic shot at a meaningful reduction. Assessors work from broad market data. They do not always account for the specific characteristics of your property, the condition it is actually in, the street it sits on, the things that make it different from the houses they used as benchmarks. That gap between what they assumed and what your home is actually worth on the open market is exactly where appeals succeed. This is not complicated. It does not require a lawyer. It requires a phone call and a little research. Action. Call your county assessor's office today. Ask for your current assessed value, and ask whether it has been updated recently. If it has, ask what the appeal deadline is. Put that date somewhere you will not miss it. 2. You may qualify for senior tax relief you never claimed, or were denied for before. This is where the real money is for most senior homeowners. And it is the area where the most people are leaving savings on the table without knowing it. At least 39 states, plus Washington, D.C., offer senior-specific property tax relief programs. The structures vary. Some reduce your taxable value outright. Some freeze your assessed value, so that no matter how much the market rises in future years, your bill stays flat. Some let you defer increases entirely until you sell. Some cap what you owe as a percentage of your income. Not one of these programs is automatic. You have to know they exist, confirm you qualify, and file an application. Here is where seniors get caught. Many of these programs set their income eligibility limits years ago and never adjusted them for inflation. Meanwhile, Social Security recipients have received cost of living adjustments every single year. So a homeowner whose income crossed an outdated eligibility line was denied, not because their financial situation improved in any meaningful way, but because a number in a piece of old legislation did not keep pace with reality. That is starting to change. Several states updated their programs for 2026, and homeowners who were turned away before may now qualify. Illinois raised the income ceiling for its Senior Freeze program from $65,000 to $75,000. That freeze locks your assessed value in place. Future market increases cannot touch your bill as long as you qualify and stay in the home. For a homeowner in the Chicago suburbs where assessments have been climbing, that protection is worth real money every single year going forward. Texas expanded its over 65 homestead exemptions significantly. New Jersey launched the full rollout of its Stay NJ program. Qualifying seniors can see their property tax burden cut nearly in half. Missouri expanded both the income limits and the credit amounts on its senior property tax credit. And these are just the states that made headlines. Many counties have their own local programs layered on top of state programs that most residents never find out about because nobody advertises them. Deadlines are real here. Pennsylvania, for example, recently extended the deadline for its property tax and rent rebate program to December 31st, 2026, giving seniors more time to apply under newly expanded income caps. Colorado's senior exemption application closes July 15th. Your state or county may have a window that closes before summer ends. If you were denied before because your income was slightly over the limit, reapply. The threshold may have moved. If you have never applied at all, there is no good reason to wait. Action. Call your county assessor's office or your state's Department of Revenue. Ask two things. What senior property tax relief programs are available in my state? And have the income limits or benefit amounts changed for 2026? Then, ask for the application and the deadline. That one call could save you hundreds or thousands of dollars annually for as long as you stay in the home. 3. Reverse mortgage obligations do not go away. And 3 situations are catching families off guard. A reverse mortgage gives you access to your home equity without a monthly payment. But it comes with ongoing obligations that do not disappear with time. And right now, 3 specific situations are putting families in difficult positions. The first is extended medical absence. Under HUD guidelines, a borrower who is in a nursing facility, rehabilitation center, or hospital for 12 consecutive months or longer is considered to no longer occupy the property as their primary residence. At that point, the loan can become due. And here is a massive trap for families. If an older spouse goes into a facility, but a younger spouse who isn't legally on the loan is left in the house, the clock is still ticking. The occupancy rule applies specifically to the borrower. This policy is not new, but families consistently underestimate how quickly 12 months arrives when a parent's recovery is slow or uncertain. By the time they realize the clock has been running, the servicer has often already begun the process. HUD does have a hardship extension option, but it only works if you engage before the loan is formally called. Once a due and payable notice is issued, your options narrow considerably. The second situation is deferred maintenance. The loan requires you to maintain the property in a condition that does not diminish its value. For a homeowner on a fixed income who has been putting off repairs because money is tight, this creates a bind. A property inspection that flags significant deterioration can result in a cure notice, a required list of repairs with a deadline attached. Miss the deadline, and the loan can accelerate. The third is falling behind on property taxes or homeowners insurance. Both are ongoing loan conditions. There is no informal grace period here. A tax delinquency or an insurance lapse is a default event with the same weight as any other breach of the loan terms. If any of these situations sound familiar, the time to act is before a formal notice arrives, not after. Action. Pull the reverse mortgage documents and read the occupancy, maintenance, and property charge requirements. Confirm that every condition is currently being met. If a family member is in a medical facility right now, call the loan servicer this week and ask directly where the occupancy clock stands and what formal options exist. Do not assume someone else has already made that call. 4. Deferral programs let you postpone the increase, and few people know they exist. A deferral program is different from an exemption. An exemption reduces what you owe. A deferral lets you postpone paying a portion of your bill. The deferred amount becomes a lien on the property and is repaid from sale proceeds when the home eventually changes hands. For a senior who plans to stay in place long-term and is facing a tax bill that is straining a fixed-income budget, this is sometimes the exact tool that makes staying in the home financially viable. The alternative for too many people is being forced into a sale, not because they want to move, but because the monthly cost of staying became impossible. California's property tax postponement program is available to homeowners 62 and older with income below roughly $55,000. Vermont offers deferral at 0% interest, among the best terms available anywhere in the country. Other states have their own versions with varying income limits and age requirements. Some of these programs have enrollment deadlines in summer 2026. A single phone call is all it takes to find out whether your county has one and whether the window is still open. Action. Call your county assessor's office and ask whether a senior property tax deferral program exists in your jurisdiction. Ask what this year's application deadline is. That call takes 5 minutes and could protect thousands of dollars in housing costs over the coming years. And if you have a reverse mortgage, your insurance renewal needs attention now. Homeowners insurance premiums rose 46.8% cumulatively from 2020 to 2025 nationally. Louisiana is up 58% in 2026 alone. Michigan up 48%. Some states have seen premiums more than double over 5 years. For a reverse mortgage borrower, an insurance lapse is a loan default event. Same weight as a missed tax payment, and it can escalate faster than most families expect. If your premium has jumped to a level that is genuinely unaffordable, or your carrier has issued a non-renewal notice, do not let the policy lapse while you are shopping for alternatives. Contact your state's Department of Insurance immediately and ask about insurer of last resort programs. Florida has Citizens Property Insurance. California has the FAIR Plan. Every state has an equivalent. These programs exist for exactly this situation and are frequently less expensive than what a panicked, last-minute replacement policy would cost. Action: pull your current policy and your most recent renewal notice. If the premium has increased significantly or a non-renewal is coming, call your state's Department of Insurance before the policy lapses. Your action list. I am going to give you a 5-step action list. Grab a pen. If you are driving, listen now and come back to this later. Ready? 1. Call your county assessor. Get your current assessed value. Know your appeal deadline. Point 2. Check your state's senior relief programs. Several updated their limits for 2026. Apply now or reapply if you were denied before. Point 3. Review any reverse mortgage in the family. Occupancy, maintenance, taxes, insurance. All 4 conditions confirmed current. If a family member is in a medical facility, call the servicer this week. Point 4. Ask about deferral programs. One call could protect thousands. Point 5. Review your insurance renewal. If it is unaffordable or a non-renewal is coming, call your state's Department of Insurance before the policy lapses. One call from this list could save you more than a year of Social Security payments. Make it this week. Share this with every senior homeowner you know. And subscribe, because the next deadline will not wait for you to find out on your own.